Hey everyone, welcome back. We are going to talk about the FOMC minutes, which are coming out. I do have a quick announcement, which I'm going to talk about. And then we're going to get into some expectations about multiple compression, how much we could see based on Fed drawdowns. And we'll also talk about the minutes and so on and so forth. So let's get into it. First, the quick little announcement. It probably will start this, I would say, Monday. But a lot of people have been asking for like a subscription way to be a part of the Market Open live stream rather than like buying a program or whatever. The join button now has that. It's expensive. It's cheaper if you buy a program rather than that, but I wanted to put that out there. I did throw that in there. Probably Monday we'll start having the links in there. But anyway, let's get into what we're here for, and that is talking about the Federal Reserve. So first of all, we know that the balance sheet is at $8.9 trillion. The current best estimates that we have is for every 1% drawdown that we see of the balance sheet of about $90 billion, we expect to compress multiples by about 1/3 of 1%, maybe slightly less, like 27 basis points. So the balance sheet drawdown isn't likely to be the biggest issue of concern to the markets unless the Federal Reserve comes in with large drawdowns. If they go with $90 billion a month of drawdowns, you're really only seeing multiple compression of like 3% over the course of a year, right? Three and a bit. However, if they start blowing off this balance sheet, you could really see some substantial multiple compression, which if you're not familiar yet, which at this point you should be if you watch the channel, you should be pretty familiar with multiple compression. I will just give an extremely quick example here. Very, very quick example of multiple compression. You've probably already seen me do this, but it's just the easiest way to do it. If you make $100,000 in rent on a building, and it is selling for 20 times gross. This is very similar to your PE ratio, right? It actually is probably more like price to sales, quite frankly, but we'll go with price to sales, similar, because cap rate would be more like PE, but whatever. 100K rent, 20 times gross, then the building's worth $20 million, right? Let's say you raise the rent, you raise the rent to 120. Yay, I've raised the rent. We're making more money and maybe we're running the building more efficiently or whatever. Who cares, right? Well, the unfortunate problem about this is if multiples compress to, let's say, 10, your building's only worth 1.2, right? I don't know, I'm covering that up a little bit. But whatever. You've seen this story before. You've seen me talk about multiple compression before, and it's really important to know that multiple compression is why the stock market has been having a lot of heart palpitations, because we just don't know how quickly the Federal Reserve expects to draw down these their balance sheet. And of course, we don't know exactly what to expect in terms of rate hikes. So those are the big things that we're looking for right now. In fact, we are expecting the market, Fed funds futures, they're pricing in about a 50% chance of a 50 basis point hike on the March 16th FOMC meeting, which of course starts on the 15th, ends on the 16th. We are now looking for clues that could help us determine, should we expect this 50 basis point hike, or are we going to follow the doves and basically just end up doing little 25 basis point hikes, which 25 basis points, you might think, oh, it would be a good thing if we did 25 basis point hikes. But the problem with that is it reiterates the inflationary concerns that, wait a minute, if the Fed is so far behind the curve and they're still refusing to get ahead of the curve, what's their problem, right? What like they're losing it. And so this is something that we have to be cognizant of, is that to some degree, a 50 basis point hike would actually be good. Again, the market right now pricing in about a 50-50 chance. It's probably about 55% chance, 50 basis points, and 45% for a 25 basis point hike. We will know more though, maybe from today's minutes. Certainly we'll know when the meeting actually comes. So then we've got, let's see here. Okay, so then we're looking for inflation clues. This is big. So we're looking for three big things. Number one, we are looking for inflation clues. What is the Federal Reserve seeing when it comes to inflation? Look, if you read the earnings calls, which every single day, I sit around the Bloomberg terminal and I read earnings calls. Every single freaking earnings call is the same thing. We have pricing power. Not only do we have pricing power, but we're raising prices. And if anything, we are behind the curve on pricing power, which is absolutely insane. So companies are seeing the inflation like crazy. I mean, we talked about that this morning, with Heineken and Kraft and Advanced Auto Parts, and this comes after Kimberly-Clark and all of the other companies. So we're looking for inflation clues. We're looking for clues as to the 50 basis point hike, and we're looking for the pace of drawdowns. We are looking for those three things. Very, very important. And remember that the balance sheet reduction, I would write this down if I were you. The market is expecting that every 1% drawdown is worth about 1/3% in valuation multiple. Okay, so now let me see here if, okay, well, this iPad's being stupid. Hold on a sec. I'm going to restart this thing really quick. What we're going to do now as well is we're going to look at the December minutes just to get a little bit of a refresher here. 10-year yields popping up a tiny little bit right now. We're at about 2.06%. Keep in mind, though, these 10-year yields are being compressed a little bit thanks to a flight to safety because of the continuation of this drama that we have with Ukraine and Russia. Shout out, by the way, to Topo Chico, not sponsored, but this video is brought to you by StreamYard, which helps me not only put together these live streams and broadcast them to you, but also throw up comments so we can respond to them. Or I can also multi-stream this on like Twitter or Facebook or Twitch, everything all done through StreamYard. So very, very great quality platform. I've been using them for probably years now. Okay, good. So let's do a very brief little check here on the market. Shopify obviously hurting almost all of e-com. And this is a problem because Shopify forecasting a slowdown in the second half at the same time as inflation lags is not good, because then you have a certain overlap period of stagflation, which is worst case scenario. This is what we don't want. We want to stay away from that. Okay, here we go. Stupid updates done. All right, good. So now a quick look here at the markets. So you can see e-com getting hit here. Matterport does report after hours. We're off the bottoms for things like Etsy, Shopify, Cloudflare getting hit about 5% today. Probably as you see e-com fall, you might see some of the cybersecurities fall as well. You do have upside here over at Upstart and Corsair, as well as Gold and Airbnb. So a little bit of a mixed day. Indices obviously down ahead of the minutes, and of course following what was a very good rally yesterday. Great rally yesterday in markets. Here's Tesla sitting at about 904, off of some of those highs that we saw yesterday around 930. Okay, so let's look briefly at the SEP, which we are not going to get another SEP, which is a summary of economic projections, until, unfortunately, March. And one of the things that's wild here, okay, I want to point this out to you right here. This is very, very important, because this is going to be something that we're looking for clues in, is you see this right here, how it says stupid pencil. Come on, man. What's going on with the iPad today? Jeez, man. Whatever. So you see where it says September projection? There we go. Right here. And then Fed funds rate, right? The September projection was that by the end of 2022, we would see rates at 0.3%, which is like laughable, right? This was like inflation is transitory, right? Then they're like, okay, in December, they're like, okay, it's not as transitory anymore as we thought. We think rates are going to get to 0.9% by the end of 2022. Well, Jerome Powell told us in January at the meeting we're about to get the minutes for, he told us that if he had to go back and revise his summary of economic projections, he would revise up. That's what he told us in January. That means the notes we're about to get probably not going to be pretty. Heads up, probably not going to be pretty. Now, it's an issue. The consideration is how much of this is already priced in, and obviously we'll see. Joe from Miami. Folks, price increases are not letting up. I'm part owner of a plumbing supply, and we are dealing with increases constantly. Severe lead times and availability. I foresee further impacts to housing in 2022. Wow, Joe. Well, thank you for donating $20 to mention that. That's wild. Appreciate that, John. Thank you so much for the $50 donation. That's really nice of you. Okay, follow me, by the way, on Instagram and Twitter if you have not yet. At MeetKevin on Instagram and at RealMeetKevin on Twitter. And you get to see me post stuff. Duh. Okay, so now we need to look at quickly, because we only got 5 minutes left here. We're going to quickly look at the last set of minutes that we got, okay? This was a disaster. This came out on January 5th. This was from the December meeting, right? This was just a disaster. I filmed it. You could look at this YouTube video. It was live. Worst report yet from the Fed, right? And this was released January 5th. I covered it, and it was horrible. The worst I've ever seen. And I study the Fed a lot. This was very, very, very bad. So I'm going to just do kind of like a look at some more of the salient aspects here. But some of the things that we got from this are talking about the potential for a faster rate hike, the potential for a faster runoff, because the balance sheet is not only larger, but they also have different durations of bonds that they want to run off quicker. They see inflation higher at the same time as they see the economy needing less support. And they mentioned words that were very critical, like significant pricing pressures for inflation, right? Closer to liftoff, how they want to reverse the course of this inflation. And by doing that, they have to use the tools on their tool belt, right? But they've also talked about financial stability risks in the last one, which is a fancy way of saying recession, right? They talked about how economic activity has downside risks and inflation has upside risks. They talked about how inflation is broadening in categories. I think like every day there's somebody who leaves a comment on my channel about how, oh, it's the inflation is just used cars. Dude, that's what it was last year. Not anymore, right? Take a look at this. Let me just read you a section of this. This was again from the last one here. We'll read a couple lines here. Let's see here. Federal Reserve is better positioned for normalization than in the past. Balance sheet runoff commenced. They're talking about the past. Okay. At some point after the first increase in the target Fed funds rate is when they're going to start the runoff. At some point after, that implies that they're not planning on or starting their runoff probably until May or June, since there's no meeting in April. However, participants judged that it would be appropriate that the timing of the balance sheet runoff would be closer to that of policy rate liftoff than in the previous experiences they've had. And that's because their current outlook is that we've got stronger economic outlook, higher inflation, and a larger balance sheet, warranting a faster pace of policy normalization. This was pretty bad. I mean, we're not going to go through all of this here, but a few of these participants raised concerns about a relatively flat yield curve and potentially adversely affecting interest margins for some financial intermediaries, which may raise financial stability risks, right? This was their sort of like, hey, we got to start looking like, are there potential recessionary fears, right? This is where they told us, again, these are the December meetings minutes. We're getting the other minutes in about 2 minutes. A lot of minute talk here. But anyway, inflation readings remained high and various indicators suggested that inflationary pressures had broadened in recent months. This was all from December here. Real PCE growth appeared to be picking up inflation despite an upturn in inflationary pressures. Shipping congestion and other bottlenecks continued to restrain overall, growth and trade. Persistent bottlenecks, right? So we're going to want to see differences. I want to see differences in tone. Like ideally, they come out in these minutes and they start saying things like, hey, we're seeing inflation get better. We're starting to see it be less broad-based. We're starting to see the supply chain bottlenecks get better. This was a summary that I made the last time. Yeah, a lot of notes. Trailing default, still low defaults. Potential for less accommodative policy stance, blah, 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 blah. Okay, good. So let's briefly listen into CNBC here while I get the minutes ready, which come out in a minute.
The main point to keep in mind with this proposal for the federal gas tax is primarily just to show voters that they're talking about things they can do, that they're aware that it hurts people's pocketbooks, that they are at least trying to put things on the table, even though behind the scenes, what I'm hearing from a lot of aides is, that there aren't that many pros to it. It's really hard to put something like this back in place once you roll it back.
Yeah, and if they were to let it go for a while, would they?
So they're talking about this gas tax holiday and whatever. I'm occasionally going to throw up the SPY. That's going to be the SPY that's going to be above my head. All right, here we go. It's 11. Here we go. Dude, this website's going to crash, man. CNBC is probably going to beat me to it. But we'll go through it together, word for word.
Opposing any potential rollback of the gas tax.
Come on.
So certainly there are a lot of critics of doing this, even though the White House is trying to show voters it cares.
Kayla, thank you. Kayla Tausche with the latest. All right, that does it for the exchange, everybody. Power Lunch picks things up right now.
Still not out. Come on, man.
Kelly, thank you very much. And breaking this hour, the Fed minutes. Details from the central bank's last meeting are being released at this hour. Investors will be looking for clues on the size of a potential rate hike in March. Also about its shrinking.
Okay, looks like they are, Bloomberg has them. I don't have any summary of it yet. Still waiting.
Let's get a quick check on the markets. Here's where we stand as we await the Fed headline.
No, I think they just released the title. They actually don't have them yet. SPY's actually moving up right now. Got them. They're out.
136. Let's check on that 10-year
Look at the
yield
SPY moving
as
up right
well.
now.
See
So
where
maybe there's
that's
some good news
standing.
in here.
The latest
The
is about
algorithms are going to start trading this right away.
2.063%.
Remember that. Algos trade first. Minutes, released, attached. Okay, it's just taking a second to get this up.
And Greg DeMarzo is portfolio manager with Rockland Trust. Mike Santoli with us, as is Rick Santelli, who will help bring us the headlines as they cross. And Steve Leisman will be joining us in just a few moments. Let me go to you.
Let's hope that optimism stays. I'm just waiting for them to download. Everybody's on this right now.
Well, it gets a little bit tough, Tyler, because in a way, the January 25th, 26th meeting and the minutes therein might be considered a bit old, because since then we've had a big jobs report. We've had updates on both inflation numbers, CPI and PPI. Both of those were hot. Every release actually has had any pricing component has been rather on the hot side, and especially
Got it. All right, let's go. Let's just start by searching a little bit. I'm just going to search inflation. Okay, we're going to say, oh my gosh. Okay, lots on inflation here. So, employment, inflation, long-run interest rates fluctuate over time. Inflationary pressures. Regarding monetary policy outlook, here we go. With data showing continued tightening of labor market continues and elevated inflationary pressures, policymaker communications were perceived as pointing to an earlier and faster removal of accommodation than market participants had previously expected. Against this backdrop, respondents to the open market desk surveys of primary dealers almost uniformly projected that the Fed's net asset purchases would end by March 16th. We already know that. Expectations for the path of the Fed funds rate shifted towards an earlier rate increase. Interest rate futures priced in an increase. Okay, I want a little more talk about inflation here. Inflation, come on. Inflation rate over the longer run is primarily determined by monetary policy, trying to get to 2%. Okay, where are the big ones here? However, under the circumstances, the committee judges that objectives are not complementary, takes into account employment shortfalls and inflation deviations. Come on, what are the big ones? All right, let's get forecast, please. Okay, return of inflation. Okay, here we go. Inflation readings remained high. Various indicators suggested that inflationary pressures had broadened over the second half of 2021. Okay, PCE 5.7, that's already old news at this point. Some of this data. The Staff Common Inflation Expectation Index, which combines information from many indicators of inflation expectations and inflation compensation. This is good. Had largely leveled off over the fall and was close to a 2014 average. Okay, so I'm not sure exactly what they mean by this 2014 average, but that sounds good. However, shortages of construction materials and building lots and other inputs continue to weigh on activity. Do we have good news here? Let's see. This is going back to November. Sharp rise in COVID cases. Housing demand remains strong. Okay, no. Business fixed investment appeared to post only small gain in the fourth quarter. Manufacturing output moved down in December after advancing strongly in October, November. Let's see here. Total real government purchases appear to have fallen. Trade deficit widened. Global inflationary pressures. Broad equity indices decreased markedly. So they're noticing that stock prices are going down. Global inflationary pressures. Tensions between Russia, Ukraine. Here we go. Inflation abroad continued to rise. Okay, what is this? That said, input and output price components of the Purchase Managers Index provided some tentative signs, this is good, of easing supply constraints had started to contribute to some let-up in inflationary pressures in several foreign economies. We're seeing that in China, too. That's actually good. Okay, let's see more here. Downside risk to activity and upside risk to inflation. This is the staff economic outlook. The staff's near-term projection for PCE inflation was revised up relative to December. Okay, we know that. In particular, the staff continued to expect monthly inflation rates would move lower as supply constraints eased, but the projected step down was less pronounced than the December forecast. Even so, an improvement in supply chain conditions and a decline in consumer energy prices were expected to slow PCE in 2022. Okay, so this is where they're saying, hey, we still think commodity prices are going to go down. Supply chains are going to get better. So you still see some of the Fed talking about maybe some of this like, hey, we still think things are going to get better. Okay, so either they've lost the plot or they're seeing something. The staff continued to judge that the risks to the baseline projection for economic activity were skewed to the downside and that the risks for inflation were skewed to the upside. Okay, that's not good, but that's the same thing they said last time. Okay, let's see here. Progress on vaccination, easing us about were expected to continue to support gains in economic activity as well as reduce inflation. Okay, but what's actually happening? Participants remarked that recent inflation readings had continued to significantly exceed the committee's longer run goal, and elevated inflation was persisting longer than they had anticipated, reflecting supply and demand imbalances related to the pandemic. However, some participants noted that elevated inflation had broadened beyond sectors most directly affected by the pandemic. That's not good, mostly bolstered by strong consumer demand. In addition, participants cited other developments that had the potential to place additional upward pressure on inflation, including real wage growth. This is where that wage price spiral comes in excess of productivity growth and increases in prices for housing services. This is another thing that's concerning to folks, is seeing services. FOMC, and I'm quickly just cheating here, looking at Bloomberg notes. FOMC sees tightening pace of inflation or tightening pace of faster tightening if inflation doesn't move down. Many participants saw the chance of selling mortgage-backed securities in the future. Let's see here. They're still TBD here. Same note about balance sheet runoff will be quicker. Participants noted that elevated inflation was a burden to U.S. households, particularly those who were least able to pay higher prices. This is a big deal. Remember, the Fed cares a lot about people who have the lowest incomes because there's little they can do for them. Participants generally expected inflation to moderate over the course of the year as supply and demand imbalances ease and monetary policy accommodation is removed. Some participants remarked that longer-term inflation expectations appear to remain well anchored. This is good too, right? We did see inflation expectations come down in the last consumer sentiment surveys, which supports inflation going to normal levels over time. That's good. Definitely a lot less of a painful tone than they had in the last one. In the discussion of risks to the outlook, participants agreed that uncertainty regarding the path of inflation was elevated and that risks to inflation were weighted to the upside. This is the same thing they said over and over again. Several risks, such as the zero tolerance policy in China, supply chain disruptions, geopolitical turmoil, increases in global energy prices, worsening of the pandemic, persistent real wage growth in excess of productivity growth. We know this. A few participants pointed to the possibility that structural factors had contributed to low inflation in previous decades, such as technological changes, and that those may reemerge when the effect of the pandemics abate. This is the Cathy Woodian argument, right? That basically, like, eventually inflation is going to go down. And that's not wrong. Like, I'm on the same boat. Eventually, it'll go down. It's just, is it going to go down before a recession is the question. Okay, so inflation, let's see. They also anticipated that it would be too soon to raise the target range. What is this here? So in the consideration, the stance of monetary policy. Oh, okay. This is referring back to the January meeting where basically they're saying, hey, too soon for us to raise rates now. They would begin removing policy accommodation could soon be warranted. Participants that noted that inflation continued to run outside. In light of inflationary pressures and a strong labor market, participants continued to judge that the committee's net asset purchases should be concluded soon, most obviously referring to an end in early March. Right now, we are tentatively scheduled to see the end of this policy accommodation, the money printing, basically, March 10th. Write that date down if you haven't yet. Okay, implications for the future. Okay, so the implications of economic outlook compared to conditions in 2015. And this is another thing, like everybody on YouTube keeps putting up these charts about how great the market was during rate hike cycles, but we don't have the inflation that we used to have. And we certainly didn't have the balance sheet that we used to have. Compared with conditions in 2015, when the committee last began a process of removing monetary policy accommodation, participants viewed that there was a much stronger outlook for growth in economic activity, substantial, which is good, but also leads to more inflation, right? Substantially higher inflation and a notably tight labor market. The more tight the labor market is, the more they can fight inflation. By the way, the market is slightly recovering right now. The market actually isn't getting shocked to the negative like they did the last time these minutes came out. So far, this is all along expectations. Let's see here. No real details here, but committee acknowledged that. Okay, I already read that. I already beat them to that. Let's see. Consequently, most participants suggest that a faster pace of increases in the target range for the Fed funds rate than in the past would likely be warranted should the economy evolve in line with expectations. Not a lot of insight so far in inflation. Just kind of like we think it's going to go down, but not much right now in terms of new data here. Most participants noted that if inflation does not move down as they would expect, it would be appropriate for the committee to remove policy accommodation at a faster pace than they currently anticipate. We know this. Some participants commented on the risk that financial conditions might tighten unduly. And this is the risk, right? This is the recession risk right here, is that if you tighten too hard, few participants remarked that this risk could be mitigated through clear and effective communication. And this is why they don't want to like shock the market by doing rash things. They want to be very methodical with what they're doing. Now, I want to be very clear about that. That does not mean the Fed wants stocks to go to the moon or cares if they go down. Ultimately, the Fed's job is dealing with inflation and jobs. That's it. But they don't want to like rug pull to where all of a sudden banks freak out, right? There's a lot of nuance here. But anyway, so far, nothing like shockingly bad, which is good. Members remarked that supply and demand imbalances related to the pandemic and reopening had continued to contribute to elevated levels of inflation. This is pretty much the same thing that we've seen. Inflationary pressures. I'm just jumping to the word inflation right now, and then we'll look for other things too, like supply. I want to see expectations. Okay, inflation pressure, strong labor market. Trying to get new info here. We've done those, done these. Okay, that's the statement they released last time, so that's fine. Not a lot of information on the balance sheet, honestly. I'm going to look at supply here really quick. Business fixed investment. We talked about this. Supply bottlenecks and limited supply of construction activity. This, by the way, worsened this morning, construction activity and supply issues. Somebody even donated money earlier in this live stream to say that they work for a plumbing supply company and they're seeing things get worse. A lot of companies, not a lot of forward-looking information in these minutes here. At least it's not worse, though. It's not like a shocker like last time. PMIs pointed to improved supply. This is good. Supplier delivery times at foreign vehicle production rose notably, suggesting that supply bottlenecks continue to ease somewhat. This is actually good right here, right? Incoming data set, but this is all about the foreign economic growth. Is this easing right here? So talked about that. Let me see other supply notes here. Supply. With sales running low. Okay, what is this here? Financing conditions for consumer credit remained accommodated for most borrowers. Lending standards continued to ease. Lending standards easing is not ideal, but that's okay. Sales running low where? There's a ban. Okay, here we go. Sales running low because of constrained supply. Auto loan growth continued to slow in October, November. This is looking back. We just saw a banger for car sales in January. Over 5% increase in car sales in January, which we were expecting a decline. Household delinquency rates remained relatively low. That's good. While household borrowing rose, but was mostly concentrated among prime borrowers. That's very, very important. For financial stability, right here, very, very, very important. You don't want to see more subprime borrowing. You want to see, I hate to say it, but basically like wealthier people borrow money and poor people not borrow money because it's obviously the risks associated with that to the economy. And that's a very rash and bad summary, but I think you know what I mean. All right. So let's see. Omicron virus, supply chain. This is about maybes. Supply chain issues continue. This. Well, here we go. Hold on. What is this? Although real GDP appeared to have posted a sizable gain in the fourth quarter, output growth was expected to slow noticeably in the first quarter before picking up later in the year as COVID cases declined and supply chain issues continued to resolve. Okay. Hopefully we get more growth in the second quarter, but that's not what Shopify told us. I feel like I'm looking a little bit into the past here because we've got so many earnings reports telling us the opposite. The earnings reports are telling us things are getting worse with supply chains and worse with inflation. The only ones that seem to have somewhat of a handle on supply chains were like companies like Apple and AMD, yet both of them suggested they were able to raise prices and that supply chain issues were still significant, was Apple's quote, right? So a little bit, I feel like this was done. This meeting did come before earnings season, but there's at least there's no shocker here to the downside. Supply chain continues, conditions expected to normalize further, but labor market is still very tight. Okay. Participants noted supply chain bottlenecks and labor shortages had continued to limit businesses' ability to meet strong demand, right? With these challenges exacerbated by the emergence of Omicron. Well, that's almost over now. What is this here? Most participants think that if inflation, okay, this is an interesting note from Bloomberg. Most participants think that if inflation doesn't decline as they expect, they'll have to raise rates faster, and that's not surprising. But that this was interesting here, but thinks that some phrases noting that some members of the FOMC worry that rapid removal of policy accommodation may unduly tighten financial conditions. Maybe that's what's leading the market to actually be happy right now. That it's basically no Bullard rug pull, right? That is good. See right here, that's this line, which we highlighted right here. This line right here might be why the market's actually happy about this. This could be a big old bottom line right here, is more of this. And these are people like Mary Daly who come out and they say, hey, let's communicate clearly. Let's not rug pull like we did with the last minutes. Let's just give clear communication. We're not going to go rug pull. And if anything, that could actually be somewhat implying like maybe they'll just come in with that little baby 25 basis point hike. That's good because it means less chance of a rug pull soon. It's potentially bad, though, because if inflation does not go down, then they might have to be more aggressive in the future. Treasury yields falling a little bit. Let me see here because they were rising right before the meeting. I do think they're relaxing a little bit, which is also good. And SPY popped up a little bit, maybe about 0.25% here. Not like a big rally, but let me get the 10-year yield quickly. Yeah, okay, it's at 2.03, so still sitting above 2%. That makes sense. Okay, let's see what else we have here. A little more dovish here, I'd say. Yeah, this is definitely a much more dovish tone these minutes than what we've been seeing, what we saw in the last one, which is really, really good. Yeah, this is sort of intro of their operations, currency holding, additional matters. That's fine. This part isn't so important. Longer run goals. We know what their longer run goals are. Open market operations. Talked about this. Okay, principles for reducing the size of the balance sheet. Participants continue to discuss topics associated with the potential adjustments here. Bloomberg already spoiled this for us and told us they didn't really tell us anything. Let's see here. What is this? Participants' discussion was preceded by staff presentation that reviewed key considerations raised by participants at the December meeting and examined how proposed sets of principles compared to basically they're comparing the runoff that they started doing in 2014 and 15 with now. Participants agreed that details on the timing and pace of balance sheet runoff would be determined at upcoming meetings, and that they generally noted that they would likely warrant a faster pace of balance sheet reduction. No surprises in this. No surprises here. If anything, it reiterates their interest in not rug pulling us, which is definitely, it's pushing. You can see the SPY above my head right here likes this. You can see the SPY's been kind of tentative, though, because it's kind of like, where is it? Where's the bad news? We haven't really seen it here. So let me see here if there's anything else. Let me see what they say here about stocks, because this section could be very interesting. Okay, let me get rid of that for a second here. Real government purchases fell in the fourth quarter. That makes sense. U.S. international trade deficit widened. That makes sense. Service exports jumped in November, reflecting a sizable increase in exports of travel services after the reopening. Yeah, travel's blowing up. I mean, that's why Airbnb is just killing it right now. People are spending money like nutso. Let's go over here. Let's see. Overnight repurchase facility increased. Yeah, this just means we have more cash in the market available right now, which is true. Expected path for the Fed funds over the next few years, implied by a straight read of overnight index swap quotes, rose notably since the December meeting. This is what they want, though. They want a pre-signal to markets that they're going to raise rates, and they want the market to start pricing in those rate increases, so that way they don't rug pull. Particularly in the latter part of the meeting period, as shifts in expectations about the pace of monetary policy tightening and global inflation and tensions of Russia and the Ukraine weighed on equity prices. So they observed stock prices. We know that. Volatility increased substantially. Short-term, stable. Okay. I mean, I'm going to go back quickly here to their notes. Fed saw supply chain bottlenecks in January, which have been contributing to higher inflationary pressures lasting longer. Staff's near-term projection for inflation was revised up relative to December in response to slower resolution of supply chain issues. We saw that. They did boost their forecast to 2.6% from 2.1%. Let's see. Some members wanted to stop asset purchases in the January meeting, which suggests to us that the runoff has support to begin very early, probably in May, to start running off. Which is so weird because they're still printing money right now. Okay. All right. Let's quickly see how the market's reacting here. So far, it seems like positive, which is very, very good. Yeah. Look at this. Tesla gained about 1% over this release because no talk of a rug pull here. That's very, very good. So Tesla gained about 1%. Oh, look at this trade desk. Oh my gosh, look at that trade desk recovery intraday here. Trade desk ran down to 91. It was down like 8% on the Shopify news and recovered really nicely. Shopify still down about 18%. Matterport reports later in the afternoon. Little bit of a recovery. Still getting hit on Shopify, still hurting Affirm and Etsy. Remember, Affirm does the shop pay for Shopify. Still down about 3.3 here on ARC. And things that were running aren't necessarily running more, but you are seeing the indices recovering a little bit. So yeah, look at that. Nice little run right here. So that anxiety really pushing us over that 38.2 Fibonacci here, because that anxiety is now lifting from the market that the Fed would potentially rug pull us. This really then kicks the can down the road to March 16th. So hopefully we get relaxed markets between now and March 16th. Unfortunately, what we're seeing from earnings is that March 16th might not be pretty, but hopefully it relaxes. Hopefully by March 16th, we start getting evidence that supply chains are getting better. And I think that'll continue to reiterate this that we're seeing here. So I would say, as a summary of this FOMC set here, I would say good news, no rug pull. Fears of a rug pull definitely getting reduced. As a result, you are seeing indices come back to at least zero, to flat for the day, which is very, very good. Wow, somebody donated $250. I'm nearby in Malibu. Let's meet up sometime. Oh, wow, that's awesome, John. I'll check it out. Thank you so much. And wow, very cool. But anyway, wow. Thank you, Next. Thank you for that. Okay, good. So yes, this is very clear, Upsar. By the way, remember, this video is brought to you by StreamYard. So check out StreamYard for the amazing live broadcasting software they give us here, especially with throwing comments up on stream and being able to multi-stream. But this is not an inflection point to the downside. That is correct. This is basically just a continuation of what Jerome Powell told us on January 26th. We did not get any skeletons out of this meeting. We didn't get bad news. The market was pricing in the risk for some sort of downside shock. We did not get that. That is very, very good. S&P 500 almost flat now, which is very, very good. So it's neither good nor bad. I would say this was a very neutral minute release, and I like that. But it is definitely not an inflection point that the Fed all of a sudden is going to be more accommodative. That is correct. Absolutely. Sideways trading for the SPY monthly. JN is the range for the next a few months. Probably. So how do we play this report? You don't. There's nothing. But I agree with you. I do not think that we have the capacity for getting back to these all-time highs anytime soon, at least until we start getting through the taper process and then the tightening process. It is possible that, a slow bleed continues. Hopefully not, though. We just need good news already. That's what we need, is we need good news that the inflation pressures are falling. And so far, they haven't been. You've got a lot of news about, what was it? We talked about this morning. Kraft Heinz, Heineken, Wingstop, Kimberly-Clark. Almost all of the companies reporting or complaining about this being worse, not better. But hopefully before March 16th, that changes. Because otherwise, if things continue on this pace where, PMI or the PPI rather, the purchase price index comes in double the expectation for inflation for manufacturing purchases or producer purchases rather, then J-Powell's not going to be happy on March 16th. But again, hopefully we get good news between now and then. Tesla, solid recovery on the day though. It was down 2%. Look at that rally coming off here. So if you're wondering, how do you play this? Maybe you play this by going a little bit temporarily, at least you go long on some of the tech trades that are selling down right now. Who knows? Maybe Shopify could get a little bit of boost here. Other things that sold off earlier in the day, like that Trade Desk sell down was just ridiculous. I mean, the company triple beat and it was down 8%. That was just stupid. Really, really stupid. But anyway, I did also, by the way, I am long on Tesla, about 2.5% of my portfolio now. I've got about 669 shares. I picked up a bunch last Friday when the whole like Russia-Ukraine drama was going on. I picked up like 600 shares. And if you want to see how I move back into the markets, you know, it's just for perspective. It's not for you to copy, not financial advice. I have no way of knowing what your financial situation is. But do check out the Stocks and Psychology of Money group link down below. That does include lifetime access to all the content in the courses, and also includes my alerts for as I buy back into the market and get back in. I am, of course, waiting for big inflection points for a more broader portion of my portfolio, but I'll probably be nibbling in on larger dips that we see, like, for example, that Tesla one that we saw on Friday. But anyway, SPY really likes this right now, so I'm very, very happy to see this. I do wonder if oil's moving on this. We do want to see oil come down, okay? That's something else that's very, very important. QQQ, same kind of euphoria here. Very, very good. Let's quickly just look at oil, because we need oil to come down. Oil. Yeah, oil's still on the upside here. And then, of course, on yields, we are still stable over 2% here on the 10-year Treasury. But, wow, that's a lame summary, CNBC. Anyway, SPY is just now trying to turn green. I think it's about to turn green, which is very, very good. Good. I like it. Yeah, and of course, the dollar would react to the downside. The dollar would react to the downside primarily because there's no rug pull of like rates all of a sudden skyrocketing. And if rates skyrocket, then the dollar gets stronger because more people come buy your bonds. QQQ is really liking this here. It's only down about a third right now. Somebody's asking $50. Wow. My thoughts on Facebook. Multiple compression is probably going to continue throughout the year. I don't think it's a bad thing to nibble on some of your faves over time, especially since, I mean, look at the compression that we've already had in stock prices, right? But unfortunately, you jump on over to something like Shopify. You think, oh, it's down from 1,700. How much worse can it get? And you still end up with a 17% downside. The reason for that is if we do expect the economy to slow in the second half of the year, people are not going to be interested in paying these high multiples anymore for companies like Etsy or Enphase or Affirm. And so you're going to get big compression in that price to sales multiple. Anyway, so, all right, folks, thank you so much for being here. Really appreciate you.